All right. Hey, everybody online. So I was saying that this is a good time this weekend is a good time to catch up. Remember, our first exam is on Tuesday. Okay, our first exam is on Tuesday. And by the end of class today, we will have covered all of the material that's going to be on the first exam. Okay, so while we're going to have class on Monday, what we talk about Monday is not going to be on the first exam. Okay, that will be on the second exam. So this is a great time to begin studying, right? Quite honestly. And so what are some things, I think I had this conversation with some of you individually about some things that you can work on this weekend. But, you know, going back and making sure that you've read the book, right? I mean, lectures are great. Lectures are going to be the focus of the exams. But, you know, sometimes there's things in the books that can help it fill in missing details or things that we go through very quickly. So going back and using your book as a reference, maybe going back or watching parts of our class that, you know, maybe you didn't quite understand the first time. You know, now this weekend you have a little bit of time to go back and do that. I also think this is a great time to go back and work through some problems, like the problems that have been on our quizzes, and we're going to go over the second quiz here in a second. But working through some problems at the end of the chapter, maybe reaching out to somebody in class that you know and work through some problems with them, right? Talk through some things. That's, I think, a good idea. For those of you who are first years, remember in the first year seminar, we talked a lot about this idea of active learning. And so this weekend, you have a little bit of time to engage in some active learning, right? And by active learning, I mean, you know, you can begin to, right, you can begin to think about like making flashcards and do self-quizzes, self-tests, sit down with somebody else, talk through some of these things. On all of the quizzes and on the exam on Tuesday, certainly there's going to be definitions and things like that I think, you know, using flashcards or you know, practice communicating these concepts to each other, that's a good time to do this, all right? And so, right, given that we don't have that much other things distracting us this weekend, my hope is that this is a time to catch up. Because quite honestly, I have to say our performance on the first two quizzes has got me a little nervous about where we are on the exam on Tuesday, right? And that's certainly not true for all of us, but you know, definitely I think there's a few of us that are struggling, right? That have not gotten off to a great start here. And so that's okay, right? I mean, that's okay. The quizzes are not going to be, in the end, a big determinant of your grade, but they should also be worrisome, right? Because these are the kind of questions you're going to see on the exam on Tuesday, right? In fact, these questions on the quiz are questions I pulled off old exams. These are exactly the kind of questions you're going to see on the exam. And so, you know, if you're struggling on the quizzes, that's a big heads up that, you know, you got to change, you got to figure out some things. Let's talk about quiz number 2, right? Get my iPad going here. Okay. Quiz number 2. So question number 1. This asks, what component of GDP are affected by the following transactions and by how much? So A, a share of stock issued by Apple is sold for $2,000 with a $50 commission. Is that share of stock issued by Apple part of GDP? No, right? It's a financial transaction. It's a financial transaction. But that commission you pay is a service. And so what would get included in GDP? $50, and that would go into C, right? Consumption.
Would an IPO contribute to GDP?
No, because an IPO is just an issuing shares of stock, right? And it's just new stock. So no. Now, if the firm takes that money and they go and they buy investment goods, then it's included in GDP, right? At that point, it's included in GDP. But just any sort of financial transaction is not going to be included in GDP, right? Part B, an Intel computer chip is sold to China for $400,000. That's going to be, that's going to be exports, right? Goods sold abroad to China are going to be exports in US GDP, and it's going to be $400,000. And then C, Dell spends $3,000 on research and development, which fails to lead to any new products. It doesn't make any difference if it leads to new products, right? Spending on research and development is part of investment, right? So investment will go up, and it goes up by $3,000. Question number 2. Anybody have any questions on question number 1 first? All right, question number 2. Define the terms real and nominal. This is right from our book. Nominal means measured in current prices or not adjusted for inflation. Real means measured in constant prices or adjusted for inflation. Is unemployment a real or nominal variable? Well, this is a little bit of a tricky question. Unemployment has to be a real variable because it's not measured in prices, right? So yeah, unemployment is a real variable. Prices are not part of how we measure unemployment. Question number 3, name 2 differences between the CPI and GDP deflator. We talked about 3 in class. First difference is they use different goods, right? The consumer price index focuses on consumer goods. GDP deflator focuses on everything that's in GDP. Second, the CPI includes imports and does not include exports. GDP is the opposite. And the third big difference is that the consumer price index has a fixed bundle, right? While the GDP deflator does not. Okay, question number 4. Calculating GDP. So let's go through this one fairly quickly because I felt very much like a sink or swim kind of problem. Like a number of you did very well on this, and then some of you really struggled with this. So here we have data. I won't write everything up, but you have hopefully the homework in front of you, where we have data and price and quantity for 3 years. So using 2019 as the base year, here's the twist. Notice I didn't pick the first year as the base year. I picked the last year as the base year, right? In theory, it doesn't make any difference which you pick as the base year. So I picked 2019 as the base year. So calculate nominal GDP, real GDP, and the GDP deflator. Okay, so for 2017, what's nominal GDP? It's 2017 prices times 2017 quantity, right? So this would be 20 plus 100 plus 100. In other words, 10 times 20 plus 4 times 25 plus 5 times 20, right? That's what nominal GDP is for 2017. 2018, what's nominal GDP? Once again, you just use 2018 prices times 2018 quantities. So this should be 27 plus 250 plus 90 or 367. And then what's 2019? Nominal GDP. You use 2019 prices, 2019 quantities. So this should be 10 plus 360 plus 80, 450. Okay? Everybody see where I got those numbers, right? Now we got to go back and calculate real GDP. What's the difference? When calculating real GDP, we always use the same prices. We always use prices from 2019. So in other words, milk is always 10, Oreos are always 30, Doritos are always 40, okay? So what's real GDP? 20 plus 120 plus 200, right? Because we're using those 2019 prices. Real GDP is 340. What about in 2018? Once again, we use 2018 quantities, but we use 2019 prices. Okay, and then in 2019, real GDP is easy because in the base year, nominal GDP and real GDP are always the same thing. Finally, what's the deflator, right? What do we have to do to get the deflator, right, or the index? We just divide nominal by real, right? Divide nominal by real. So this should be 220 divided by 340 times 100, or 64.7. What about 2018? This is 367 divided by 450 times 100, or 81.5. And then in the base year, it's always equal to 100, right? So everybody see where I got these numbers? Everybody see where I got these? So I tried as best as possible when I was grading these, and it is hard because, you know, it's hard sometimes to see your work, but if your mistake is just a math error, I probably took off nothing or very little, right? But if it's a conceptual error, then I'm going to try to take something off, and that's usually my standard in grading these, right? If it's a math error, a simple kind of careless thing, there's going to be a very small deduction. But if I think it's more of a problem of understanding, then there's going to be a bigger deduction. So what's the inflation rate between 2017 and 2018? What do I have to do? I have to figure out the percent change in the aggregate price index, or the GDP deflator, between these 2 years. So what's inflation? It's the aggregate price index in 2018 minus the price index in 2017 divided by the price index in 2017 times 100. You should get something close to 26% with a little bit around. Right, that's the inflation rate. How about real growth? I meant to type 2018, 2019. And I typed 2008, 2009. Honestly, whatever years you pick, as long as you calculate some measure of real growth, it didn't matter to me what year you picked. I tried to follow what you did. And so what you should find is, to get real growth, you have to get the percent change in real GDP, right? So what is it in 2019? 450. What is it in 2018? 340. So you take 450 minus 340 divided by 340, 32.4%. Once again, if you made a mistake up here, but then you picked these numbers and calculated the formula right, I try not to take any points off, right? So in other words, I don't want to keep on taking points off for the same mistake over and over. If you made a mistake of calculating real GDP and you use that number in here, as long as you did the process right, then I gave you credit, right? Or tried to give you credit if I could figure out what was going on. Okay. All right, questions about question number 4? Questions? All right, these are exactly the kind of questions you can expect to see on the exam on Tuesday, quite honestly, right? One question that I did not give you on this quiz, but it looks like this is a consumer price index question, right? You worked through one in class, but you did not get one on the quiz. And so that would be something to go back and look at this weekend too. How is calculating the consumer price index different than this, right? And are you familiar with how to do that? Okay, finally, question number 5. Yeah, I think I am. Yeah, I am. Thank you, though. Appreciate the checkup. So here we have some data on the US and China with books and TV. Let me write this down. Okay, so For each country here, we need to figure out the opportunity cost. Okay, what's the opportunity cost of a US book? Well, what do they give up? They give up, right, they give up 5 TVs for every 9 books, right? Or for, yeah, right, 5 TVs for every 9 books, or 5/9 of a TV, right? What you give up relative to what you get. That's the opportunity cost, right? What do you give up? TVs relative to getting books. What then is the opportunity cost of a TV? Just the inverse of that. What about for China? China gives up 3 TVs for every 8 books, right? Or 3/8 of a TV. And then what's their opportunity cost of TV? That. Who is the low opportunity cost producer of books? China. China has comparative advantage in books, and what that means is the US has comparative advantage in TVs, right? Because 9/5 is lower than 8/3. And if you use decimals here, that's fine too. I mean, you don't have to use fractions. Whatever works for you, right? Whatever works. Yeah,
Will there ever be a comparative advantage question where one country just is overall better at both, even with like the opportunity costs?
No, because that's not possible. That's not possible, right? And the reason it's not possible is because of the idea of comparative advantage. Comparative advantage is specializing in what you do best at. You can't be best at everything. So notice here, the US is more productive at making books, and they're more productive at making TVs. But comparative advantage is getting at what you are best at, right? So you cannot be best at both. You have to be best at one thing. So what comparative advantage is finding out is where is the US advantage the biggest? That's where you want to specialize, right? Because that's where you get the most, that's where you have the most benefits. Think about it another way. The fact that the US is particularly good at TVs makes it particularly bad at making books. Because what happens when the US makes books? It's giving up the opportunity to make TVs. It's particularly costly for the US to make books. Even though they can make more, it's more costly for them to do it because they're so good at making TVs. Right? That's how you have to think about comparative advantage. So what price do books sell at? They have to sell between these two opportunity costs, right? So they have to be greater than 3/8, and it has to be less than 5/9. It has to be between these two opportunity costs. So in general, I think as a class, we did pretty well on this one. I guess if there was one mistake is that a lot of people kind of, in the process of doing this, either got it upside down, got it backwards, or got confused about what's the opportunity cost of a TV versus what the opportunity cost of a book is, right? So, you know, when you do this, just avoid the simple mistakes, right? It's the simple mistakes that can kill you. You know, label what you're doing. I think a lot of you just kind of were like scratching things up in the corner. And then when you went back and looked at your work, you just kind of were picking numbers, right? Label what you're doing, take a little bit of time, think, right? And, you know, like I said, I don't think a lot of you were completely lost on this, but I think there was kind of a lot of avoidable mistakes, right? Or getting things backwards or using the wrong numbers. And I think you probably understood what was happening, but you just, you know, you just did it wrong. So, okay, yeah, so that's quiz number 2. So anybody have any questions? So, you know, thinking about the exam on Tuesday, you can expect these same sorts of questions that you've seen on quiz number 1 and quiz number 2. It's going to be just kind of a mix. There's going to be some definitional things. There will be some problems. There'll be some graphs. There'll be some numbers. There'll be some short answers, right? So it's going to be kind of an eclectic mix of different sorts of questions. The kind of questions you will not see on this exam is I'm not going to ask for any like long essay questions, right? So there's not going to be really any long writing. I think most of the answers, like even for short answer questions, are probably more like 2 or 3 sentences, right? But you don't have. There's not going to be an exam in which I ask you to kind of write longer essays, right? So it's going to be just kind of an eclectic mix of short answer types of problems, definitions, that kind of stuff. And so, like I said, really these first 2 quizzes are really questions I pulled off old exams, right? So these are the kind of questions you can definitely expect to see on Tuesday. Okay? So anyway, hopefully that gives you a good idea of what you can work on this weekend. Okay? All right, any other questions before we move on? So the last thing that we're going to...
Can you go back down? Sorry.
I'm sorry, what did you say, Ella?
For question number 4.
Yes.
So for the for the like nominal GDP and the real GDP deflator, I'm kind of like a little bit confused around that area.
Okay, so remember what our price index is. It's just nominal GDP divided by real GDP times 100. If I can squeeze this in here. The aggregate price index, or also called the deflator, is equal to nominal GDP divided by real GDP times 100. Okay, so how did I get these numbers? I just took nominal GDP divided by real GDP, multiplied it by 100. And then to get the inflation rate, you have to take the percent change in this index. Does that make sense, Ella?
Yeah, I think so. But like, where do you get like the 10 plus 360 plus 80 equal to 450?
So that's nominal GDP, right? So that's 2019 prices times 2019 quantities.
Oh,
so
okay.
Look on your exam. The data for this is on your quiz, right? So I didn't write all that up, but that's 2019 prices times 2019 quantities.
Okay.
Just like nominal GDP in 2018 is 2018 prices times 2018 quantities.
Okay. But I thought we were supposed to find the nominal GDP for all the years, or it was just 2019?
No, for all years.
Okay.
We did this for 2017, we did it for 2018, and we did it for 2019.
Oh, got it.
Okay.
Okay.
Okay. All right, any other questions? Okay, well, so what are we gonna do here this morning? So, as I said, I really wanna finish up the material for your first exam on Tuesday, and that's continue to talk about chapter 10 on finance, right? So yesterday we talked a little bit about chapter 10, got a head start, and my goal here is this morning to finish up chapter 10, so we won't have class this afternoon, right? We won't have class this afternoon. If it's okay with you, I think we should be able to finish by 11, but if we don't get done by 11, I'd like to go a little bit past 11 just so we can finish it off. That way everyone doesn't have to come back this afternoon, okay? So we're gonna continue talking about chapter 10. Let me, let's just go back and review a little, just to kind of get us back into the mindset of what we're talking about here in chapter 10. We're talking about finance and financial systems and why they're important, right? Finance, financial systems, why they're important. And so we talk about what finance is, right? And finance is trading money across time with conditions attached, right? That's all it is. So it's not, in some sense, it's not a big mysterious thing. You're just trading money now for money later. However, there's always conditions attached to this, and sometimes those conditions can be quite complicated, right? But this is not a finance class in the sense that we're going to talk about how you price complicated financial instruments. For us, we're just kind of more interested in the big picture. And so one of the big picture things we talked about is that why is finance so important in economic development, right? Why are we talking about this in this class? And so, we talked about some of the reasons why finance is so important. First, finance is crucial to entrepreneurship, right? Getting resources to people who have productive uses for them. That's what good financial systems do, right? They get resources to those who have good uses for them. Finance creates incentives to save and invest, right? So the idea that you can save money by putting it in a bank and where it's safe and where you get a return is a very, very useful service, right? And something that, as I think I've mentioned many times yesterday, you don't appreciate till you don't have it, right? People in countries that don't have financial systems have no good way to save. They have no safe way to save, but they also have no way to save and get a return, right? And so that's a big disincentive to save. And when you don't have savings, then it's also hard to get investment because investment has to come from somewhere. The resources have to come from somewhere. Finance also helps us diversify risk, right? It's nice to be able to put some of your money in the stock market, some of your money in a house that you buy with a mortgage, some of your money in a bank, right? Some of your money in the bond market. Spreading your money around is a key part of reducing risk. Finance makes trade easier, right? It gives us things like credit cards and Apple Pay, right? We don't think about that as finance, but it is, right? What are you doing when you use a credit card? You're saying, I'm not going to pay now, I'm going to pay later, right? That's finance. So you may not think about using that credit card as a financial transaction, but it is. And then finance is also really important to providing insurance, right? I mean, when you, for instance, if you buy some life insurance, what's the life insurance company doing with your premiums? They're putting them in the stock market. They're putting them in the bond market with an eye on the fact that someday you might die, and when you die, they're going to have to pay you, right? So that's really what insurance companies do, right? Any sort of insurance company is taking your money now with the expectation that they're going to have to pay you back later, right? Once again, it's a financial transaction. We talked about the difference between savings and investment, right? Savings is postponing consumption, right? So when we save, we're basically saying we're not going to buy today, we're going to buy later. So I'm going to trade money now for money later and hopefully get a return. That's what savings is. Investment is what firms do, right? Investment is the purchase of capital by goods. I'm sorry, the purchase of capital, research and development, inventories, and new housing. And so what financial systems do when they work well is they collect people's savings and they turn it into investment, right? So if you want to think about what a bank does, a bank takes thousands of little deposits, right, from people, and then what does the bank do with that money? They lend it to small businesses or they lend it to people to buy a house, right? So that money eventually gets turned into investment in one shape or another, right? That's when financial systems work well, that's what they do. And then the other thing that we talked about, and this is going to be important for us, our discussion here this morning, and I'm not going to work through all the math here, but we talked about two equations, one for a closed economy and one for an open economy. It has to be true in a closed economy that savings equals investment, right? In other words, where does the money for investment come from? It has to come from savings. It has to come from savings. So it has to be true in a closed economy that savings is equal to investment. What is savings? Remember, there's two components of savings. How much private individuals save and how much the government saves, right? So in a closed economy, if you want to invest, that money has to come from savings. In an open economy, it's a little bit more complicated. Because what you can do in an open economy is you can have a difference between savings and investments. What's that called? That's our net exports. That's our net exports. So a country that saves more than it invests has positive net exports. Right? So in other words, when a country saves more than it invests, it's also going to export more than it imports. Another way you can say this, though, is, let me write it here. If a country has more savings and investments, their net exports is going to be positive, right? But there's a flip side of that. Having a positive net exports also means that you are a net saver, okay? Any country that has S greater than I, right? Let me just write this down at the bottom, sorry, instead of going through and recorrecting my notes. What this equation tells us is that whenever a country has S greater than I, they are a net saver. And as a result of being a net saver, they are also going to have a trade surplus. And this would be a country like Germany that we talked about yesterday, or China, that have very high savings rates relative to their investment rates. So they run trade surpluses and they're net savers. And what about the US? If our savings is less than investment, then we're a net borrower. You have a trade deficit. And this is the situation that the US has been in since basically 1980. So I went on this little rant yesterday about the fact that so many politicians, so many people don't understand this, right? That we want to blame China for the fact that they have a trade surplus and we have a trade deficit. But in reality, why do we have a trade deficit? It's really a simple matter of accounting, right? It's really a simple matter of accounting. We save less than we invest, so we are a net borrower. What's true about net borrowers? They have to run trade deficits. And so as long as we continue this situation of having less savings and investment, we're going to have trade deficits. And so what happens if we get in a trade war with China? Well, we will export less to China, and they will import less to us. But what's going to be true about the difference between exports and imports? It's going to stay the same, right? It's going to stay the same. We will not get rid of our trade deficit. All we're going to do is discourage the level of exports and the level of imports. And that's exactly what's happened over the last 4 years, right? That's exactly what happened. So, very predictable, right? I mean, I remember teaching this class back in 2016 saying, you know, what happens here when Trump gets in the trade war with China? In fact, I remember I take a class to China every other December. In fact, I'm hopeful to go back this December. If any of you want to do the last time we went was in 2019, right before COVID hit. In fact, COVID was just starting. There's actually not to get up too much on a tangent, I might have gotten COVID in China, right? Which I feel kind of special about that. You know, like I got one of the original, right? The original editions of COVID in China. It's possible that me and your fellow Cornell classmates were like patient zero, bringing COVID to the US. But we hope to go back in December. But I remember we visited university and I actually gave a talk at the university and explained this to them. And I remember the Chinese students like, oh, no, That's not going to happen, right? I can't. No way U.S. is going to get in a trade war with us. They understand simple. They understand y equals c plus I plus g plus x minus m, right? No, right? Americans don't. And unfortunately, it's been something that definitely hasn't benefited the U.S. and it certainly hasn't benefited China either. So that's kind of a brief, maybe a longer than brief recap of what we talked about yesterday. All right. Now, today, let's talk about interest rates. If we're going to understand how financial markets work, we got to think about interest rates. Where do they come from? What causes interest rates to be high? What causes them to be low? What determines interest rates? Well, as I mentioned yesterday, you have to think about the interest rate as just a price. The interest rate is just the price of borrowing money today. Mm-hmm. Market, level of funds market for borrowing money. MKT is my abbreviation. Sorry. So what determines interest rates? Well, an interest rate is just a price. It's the price you pay for borrowing money. So if it's a price, what determines prices? The market. Supply and demand, right? We have a supply is a supply of loanable funds and a demand for loanable funds. But we've actually already talked about this, because where does the supply of loanable funds come from? Where does the money for lending come from? Savings. The supply of loanable funds is just how much we save. And what determines the demand for loanable funds? Investment. So we can actually think here about a loanable funds market. Where we have savings, which is essentially the supply of loanable funds, and investment. And that determines the quantity of loanable funds that get traded, right? The amount of savings and the amount of borrowing and lending. And up here we have the price of loanable funds, the interest rate. Now let's be clear. What's the interest rate that we're interested in? Yesterday we talked about two types of interest rates: the real interest rate and the nominal interest rate. Which one really matters? Which one really matters for making an investment decision? The nominal interest rate or the real interest rate? Care that much about nominal values? No, we care about what we make after inflation, right? It really should be the real interest rate. Right? That's the interest rate that really matters. The interest rate adjusted for what the inflation rate is. So if the loanable funds market is perfectly competitive, and for the sake of argument, let's assume it is, in general, financial markets are very competitive, right? Whether they're perfectly competitive, I think is a long, complicated story. But, I think as an initial way to think about financial markets, it's probably not the worst assumption in the world to think about financial markets as competitive. And so it's the interaction with savings and investment that determines the equilibrium. And note here, we are going to assume that we have a closed economy for right now. So let's not even think about the global market, right? We're just going to assume we have a closed economy. So let's just think about the market all borrowing and lending companies. I should have mentioned that. So don't get confused in the sense that don't make this harder than it is. This is really just an application of supply and demand. Instead of supply, we call it savings. Instead of demand, we call it investment. Instead of the price, we call it the real income. It's really the same mechanics that we talked about before. And so that's what determines interest rates in an economy. Interest rates are determined by the supply and demand for loanable funds. And this, actually, let me draw a different graph. With R1 here being equilibrium, can this be the interest rate in our loanable funds market? Yeah. What? It's got a price, right? It's going to be an equilibrium. So remember, an equilibrium means nobody has any incentive to change what they do. Our people in markets going to have an incentive. Yeah, definitely, right? Because what's going to be true about this interest rate? We're going to have all of this savings, but how much is actually being borrowed? Demand is going to be much less than savings. We're going to have a surplus of funds. So will banks be happy about it? No, no. Banks don't like to have money sitting around because that's money that's not being profit. How are they going to get rid of this surplus of funds? Cut the interest rate, that increases demand, it reduces supply, and we go back to this equilibrium. So our one can't be an equilibrium because people in the market are going to have an incentive. Same for, can R2 be an equilibrium? No, because what can be true about demand for local here. But what's going to be true about supply? It's going to be way down here. There's going to be a shortage of one. Not everybody can get one. So a lot of banks can do it. They'll say, oh, well, if I can't give a loan to everybody, I'm going to start raising prices. Raising prices will increase supply. It's going to create more savings. So discourage investment, and you can do this back to delivery, right? So in either way, whether interest rates are high or they're low, there's going to be forces that converge that pushes back to the consumer. That's how competitive financial markets work. Right? Competitive financial markets, interest rates are really reflecting supply and demand in the market. And our financial markets competitive. Yeah, right? And these publishing stock tickers or you get on money, you can see that interest rates are changing step by step. Right? You can actually follow what's happening with interest rates on your right? Why are the interest rates changing? Because there's some investment in savings, right? And the investment in savings changing now. Interest rate adjusts to get them back in line. That's how competitive. So big financial markets like the U.S. with trillions of dollars in inflation, yeah, our financial markets are very competitive. Whether they're perfectly competitive, that's a big question, but they are very, very competitive. Right? They are very, very competitive. So that's, I think this is really how you have to think about financial markets. Given this, now that we understand this, we can begin to talk about things that change interest rates.
Hey, I'm really, really sorry to interrupt.
Yeah, sure.
For maybe the past 3 or 4 minutes, the audio has been really, really fuzzy. And I asked everybody else in the chat, and I couldn't hear anything, pretty much. Or at least it was really hard to make out. I think part of it is the distance from the microphone. But it's just in terms of if I were to rewatch the lecture, I don't think you'd be able to hear anything.
I don't know what to do because actually when I'm standing over here, I'm standing closer to the microphone, not farther away. Because the microphone.
When you're by the iPad, when you're writing on the iPad, I can hear. And at least right now I can hear you. But I mean, I don't know if it's true for everybody else online, but I was just having a.
Yeah, I can hear you either, Todd.
Hold on one moment. Okay, let's try this. Where I switched my microphone, so let's try this, okay? If you have any questions, if this is better or not better, let me know, okay?
This is better.
Good. I'm not sure that I was on the Apple microphone. Sometimes it flips off for reasons that I don't quite understand, but hopefully this is a little bit better. All right, thanks for letting me know. So here's our market, our loanable funds market, right? Here's our theory for what determines interest rates. Interest rates just reflect savings and investment, right? So the next part of this is, well, then what causes interest rates to change? What things cause interest rates to change? And quite honestly, the simple answer is things that shift the savings and investment curves, right? Things that change savings and investment are the things that change interest rates. Things that change savings and investment are the things that change interest rates. So let's begin by thinking about things things that shift the savings curve. One big thing is government budgets. Well, actually, let's talk about a couple of things. Changes in private savings, right? How much private individuals save? In Germany, they save about 20% of GDP. Germans are savers, right? They are kind of classic savers. China, saving rate in China, it's a little hard to say exactly, but it's probably about 30% of GDP. We have a savings rate on average of about between 1 and 3%. So I'm going to say 2% on average. Okay. So the US typically has a very, very low savings rate. We are a country of consumers and not savers. Now, this savings rate is higher right now because of COVID, right? And you can probably understand why. What has COVID done to most Americans? It's made us afraid, right? We're afraid about the future. We're afraid about losing our jobs. And so what have we begun to do? We've begun to save more. But still, our savings rate last year was only about 6% of GDP. Still much lower than what we see in most other countries. And so what impact does this have? Well, I mean, you could probably guess. What happens if you have lower savings? Lower private savings shifts our supply of loanable funds to the left, right? And what's this going to tend to do? Increase interest rates. Right? So we would expect this to put upward pressure on US interest rates, right? We expect this to put upward pressure on US interest rates. The fact that we save so little. But why is it that other countries save so much more than us? Well, some of it is just kind of preferences, right? As I said, Americans are spenders, and we're not really savers in much the way that some other countries are. But there's also another reason why, and this has to do with tax systems. Tax systems actually play a big role in influencing how much countries save. In Europe, they rely much more heavily on consumption taxes. Okay? Much more heavily on consumption taxes. So how many of you have ever been to Europe? Or actually Canada is the same way. Anybody travel to Canada, Europe, right? So one of the things you see if you go to a restaurant, for instance, you'll get a bill and it will say, the price of your bill was, €100. And if you look at the bill, it will say VAT tax, €15. Right? So in other words, of that €100 you paid, $15 of it is a VAT tax. The VAT stands for value added tax. So essentially, taxes are built into prices under a value added tax system. And when do you pay taxes? Primarily when you consume, right? When you spend. So spending is much more heavily taxed than in the US. In the US, we are actually pretty unusual. In fact, almost unique in the world that we tax income. Well, there are consumption taxes like sales taxes in states. They're relatively small. So the US is an oddball in the fact that we tax income and not consumption largely. What would happen if we switched to a consumption tax? It would discourage spending and it encourages savings, right? And so one of the reasons why the US has a low savings rate is because of the way that we collect taxes, right? Because of the way we collect taxes. I will have to tell you that most economists really don't think that the US tax system makes much sense. The value-added tax system is actually a much more logical system, right? In the sense that we do want to encourage people to save, right? One of the problems with an income tax is it discourages savings because when you save, you make income that gets taxed, right? So an income tax is actually a way to tax savings as opposed to a VAT tax, which is a way to tax consumption. So most economists actually don't think this is a really very good system. There have been plans or proposals put out there for the US to switch, right? Culturally, this would be a hard thing, but it would be possible. For instance, one proposal I saw was that to go to a national sales tax, replace our current income tax system with a national sales tax. So you wouldn't pay any more income tax, you would just pay a sales tax. How big would that sales tax be? About 30%. All right, so think about that. You pay about 30% more for everything. But on the flip side, you wouldn't have to pay taxes, right? You wouldn't have to pay income taxes. So what the money that gets withheld out of your paychecks, for those of you who get paychecks, you wouldn't have that money withheld out of your paycheck. Your paycheck would get bigger, but then your prices would get bigger too. So you can think about how that would change incentives, right? It would play a big role in changing incentives. That said, politically, the US is in many ways a very conservative country, right? Big changes like this, I think, would be hard for a lot of Americans to understand, and given our crazy political situation, I think practically it's very unlikely to happen, although it makes a certain amount of sense, right? Recessions play a big role in what happens to savings. Because COVID has increased the financial risk in many people's lives, many people have responded by saving more. What impact has that had on interest rates? Almost certainly that has pushed down interest rates, right? And you might all know this, that interest rates are at really historic lows right now for many reasons. But one of them is that there's been this big increase in savings. Okay. And then finally, another big factor is government borrowing. The government plays a big role in what total savings are because the government is it could be a big saver, but in our case, the government's a big borrower, right? Last year, government borrowing was roughly $2 trillion, right? Or roughly 10% of GDP, the government borrowed. So if you think about what's happened here in COVID, just the led to a big increase in the deficit. Right? The government has borrowed a lot more, and they're going to borrow a lot more this year, right? We're talking about the stimulus package of about $2 trillion. That's all money that's going to lead directly to the trade deficit, or I'm sorry, to the government spending, government budget deficit. So what happens if the government runs a deficit? What happens to savings? I'm sorry, supply. You have less savings or the supply of loanable funds. Goes down and shifts to the left. That drives up interest rates. This is one of the reasons why governments worry about deficits, is we worry that they drive up interest rates. This phenomenon is often referred to as crowding out. And crowding out really refers to the fact that government deficits tend to increase interest rates and make it harder for people to borrow. They make it harder for people to borrow. So maybe you're getting a little bit of a sense here why financial markets are so complicated, right? There's a lot that's going on here. In fact, if you just think about COVID, there's factors in COVID that are driving down interest rates, and there's factors that are driving up interest rates, right? So you can see why trying to predict financial markets can be complicated stuff. There's a lot of things going on, right? There's a lot of things that are going on that could be influencing interest rates every day. But if you follow the newspapers, if you read the Wall Street Journal, this is a lot of what they'll talk about, right? If you're following what's happening, interest rates, government budget deficits are important. What's happening, what's the state of the economy? That's really important, right? What's happening to our tax code? And then things that might be influencing private savings, right? All of those are really important factors trying to figure out what's going on the savings side, right, that influences interest rates. We haven't even talked about the investment side, because that's a whole other group of things that can impact interest rates. Things that shift investment demand. Okay. Clearly, one of the things that influences investment demand is expectations of the future or confidence, right? In other words, market psychology plays a big role in what's going on with investment demand. So when a firm decides that they're going to, for instance, build a factory, okay, is the firm really so much interested in what's happening today in the economy when they build that factory? Not too much, right? That factory might take 3 or 4 years to build, and then it will have a return that will go 15, 20 years into the future, right? They're not so much interested in what's happening today. They've got to be thinking what's going to be true in the future. And of course, the problem is, do we know what's going on in the future? No, right? That is highly uncertain. As a result, what can we see? When bad things happen, there does tend to be this problem of overreaction, right? And when bad things happen, firms get very pessimistic and they stop spending. Particularly, they stop spending on investment, right? And so one of the things that we see is that investment is very volatile. Investment is very volatile. It's the most volatile component of GDP. Investment rises by the most during good times, and it falls by the most during bad times. So later in class, we're going to talk about an economist by the name of John Maynard Keynes, who probably next to Adam Smith is the most famous economist, certainly the most famous macroeconomist in history. Keynes played a huge role in shaping how we think about a lot of things in modern macroeconomics, particularly how we think about recessions and depressions, right? And Keynes's idea is that in general, recessions are caused by psychology, that people get worried about the future, and what happens when they get worried about the future? They stop spending. They stop spending on consumption, firms stop spending on investment. And so Keynes referred to this idea as animal spirits. And what he means by this is that it's, we like to think that we're rational, right? That we're these rational creatures, but in reality, when we get scared, we behave irrationally. We overreact. And it's these overreaction, these kind of animal spirits, right? These are like things that are more evolutionary, right? Like sub-psychological to us. These things create booms and busts, right? These things tend to create booms and busts. So a lot of what Keynes talks about actually has been supported by modern science. How many of you are first years? Everybody is. Okay, I thought I had a couple of sophomores in here. So you guys are all familiar from our first year seminar, Thinking Fast, Thinking Slow, right? It's Tversky and Kahn. I mean, really a lot of what Tversky and Kahn talked about in Thinking Fast, Thinking Slow was what Keynes had in mind. He didn't have the psychology, degree and all the data, but this idea that people tend to overreact, that we tend to be overconfident, that we tend to make decisions based on too little data, right? All these things that Thinking Fast, Thinking Slow has identified in our psychology, Keynes had identified. He said this is a lot of what causes economic volatility, both in financial markets, right, but in the economy in general, is that we tend to get booms and busts. During good times, firms spend a ton on investment, people buy too much, the GDP goes way up, and then what happens is something bad happens, we get scared, and we stop spending, we stop investing, and the economy tanks, right? That in many ways is the root. There's more to it, but that's the root of Keynesian economics, right? This way of thinking about why we have recessions and depressions. And we'll talk about this a lot more as we go forward. So yeah, just to kind of put a graph to this, according to Keynes, what happens to a recession? During a recession, people lose confidence and they stop investing. What happens to interest rates? Interest rates drop as investment tanks. Okay. What I mentioned a couple minutes ago, what's true about interest rates right now? They're at 25-year lows. Undoubtedly, this is part of it, right? Interest rates are low because the demand for borrowing is so low, right? Firms are scared. People are scared. They don't want to borrow, right? They don't want to engage in big investment projects. at least until there's more certainty related to what's going on with COVID. And so this is obviously a big drag on the economy, right? A big drag on the economy. Let me just talk about one other thing. And once again, there's lots of things that could influence investment, a lot of things that could influence savings. I'm not going to talk about every single possible thing, but let me talk about one other thing here. And that is, sometimes there's events that happen that change the productivity of investment. Right? Sometimes there's innovation or new technologies that come about that require a lot more investment. So just to kind of pick one example of this, in the 1990s, the big advances in information technology, right? Basically, if you think about the difference between 1990 and 2000, you are all, I hate to say this, but too young to remember this. But from someone who lived through the 90s, I actually kind of have my grunge shirt on today here. But for someone who lived through the 90s, what's the big difference of the 90s? At the beginning of the 90s, nobody had a computer on their desk. And at the end of the 90s, everybody had a computer on their desk, right? That, in some sense, is the decade. And so how did that happen? Well, that took a huge investment, right? And so during the 90s, there were huge investments in information technology, both computers, but of course, networks, Wi-Fi, all of that had a very big capital component. And so one of the things that we saw during the 90s is all this IT innovation led to a big increase in investment. And I won't draw the graph, but this put upward pressure on interest rates, right? As everybody, firms, not just firms, but individuals borrowed to begin to make the purchases that they needed to get invested in this new technology. So those are some things that shift investment and shift savings, and as a result, change interest rates. Right? Now, we've been talking about a closed economy. This assumes a closed economy. What about in open economies? What's true in open economies? Well, as we talked about, in an open economy, it doesn't have to be the case that savings is equal to investment. And also, interest rates are determined by global markets, not just by your domestic markets, but by global markets. Yeah, right.
Can you move your nose quick, the little board?
Yeah. Better? Okay, so everything we talked about up to this point, we've just been assuming there's a closed economy, right? Where S is equal to I. But what happens if you have an open economy? Right? What happens if you have an open economy? Well, in an open economy, savings doesn't have to equal investment, but instead, interest rates are determined by global markets. Okay? So let's think not about the US. We usually talk about the US, but let's set the US aside for a moment. And let's talk about Canada. And you'll see why I'm picking Canada here in a minute. Let's say this is the market for savings and investment in Canada. Does Canada set its own interest rates? Not really. Canada is a small part of the world economy, right? Canada is a small part of the world economy. And so if they're an open economy, they're really what's going on in Canada doesn't really impact global markets that much. So interest rates really are a factor for Canada. They're really determined by global markets. In some sense, what's happening in Canada is really determined by what's happening in the US, right? The US in some sense is the global market. So what happens if the world interest rate is there? Right? The world interest rate is there. What's going to be true for Canada? That's going to be their investment. That's going to be their savings. They're going to have savings less than investment. How do they make up that difference? You save?
Save money.
They're going to borrow from abroad. They're going to be a net borrower. And they're going to run a trade deficit. So in this case, if world interest rates are lower than what they would be if Canada was a closed economy, it means that savings is going to be less than investment. Canada is going to be a net borrower, and they're going to have a trade deficit. And you can think about the opposite case here. If I can do it on the same graph, but just in a different color. What happens if world interest rates are up here? In blue.
Savings is larger than investment, making them would be a net loaner.
Yeah, net lender. Their trade balance would be positive. And they have a trade surplus. Okay, I've talked about Canada here. Why did I pick Canada? Quite honestly, the US case is more complicated because for the US, listen, we are an open economy, but the thing is the US is such a big part of the global economy that in many ways it's hard to tell the US financial system from the global financial system. And we'll talk about this a lot, but this is in part true because the dollar is the international currency. Most global financial transactions take place in dollars. As a result, the global financial markets are closely tied to US financial markets. But if you wanted to think about which situation is closer to the US is kind of in this situation, right? In other words, we have lower interest rates than we would otherwise have if we just dropped out of the global financial system. Why do we have lower interest rates? Because we are a net borrower. We borrow a ton from other countries. That keeps our interest rates low. That keeps our interest rates lower than they would be. How do we borrow from other countries? Quite honestly, other countries love US financial markets. They love to buy our stocks. They love to buy our bonds. They love to buy our government bonds, right? So right now, about 30% of all government debt is held by foreigners. The US is a very attractive place for people to save their money, not just Americans, but foreigners. The good thing about that is it keeps interest rates low. The bad thing about that is it fuels our, it fuels our desire to save very little domestically. And it fuels our trade deficits. So this is all, now you begin to see why economics can give people a bit of a headache, right? It's all a big web, right? It's all a big web. The fact that we save little, but we have these really attractive financial markets means that we can get away with saving little and still have low interest rates because other people save with us. But that means we're a net borrower. It means we owe other countries or other citizens potentially a lot of money. Is that a problem? Well, we'll get to that part of the web later. Okay, we'll get to that part of the web later. Should we be worried about having, so many foreigners own our debt, or should we be worried about the government deficits and government debt being so big? Well, we'll get to that question later. But you can see it's a complicated story, right? All of this stuff is interconnected, and it really gets back to a big theme of yesterday and today, which is the simple answers of like blaming foreigners for what's going on in the U.S. is almost, well, I shouldn't say almost, it is always wrong, right? It's always wrong. For the most part, our situation in regards to international trade and being a net borrower really reflects what we do here in the U.S. in terms of our policy, in terms of our desire to save and invest. It has relatively little to do with what other countries are doing. Okay, so anybody have any questions about this? Okay, I want to talk about one more thing, and then we'll maybe just do a little bit of review of some definitional stuff. How does inflation impact interest rates? Well, remember our equation. The nominal interest rate as a result, whenever expected inflation should go up, nominal interest rates should go up. So real interest rates should stay the same. So whenever there's an increase in inflation, there should be an increase in the nominal interest rate, but the real interest rate should stay the same if inflation is expected. Yeah.
What is the last symbol of that equation at the top?
Expected inflation.
Yeah, what does that read?
Well, it's pi. This is the notation your book uses. It's not a very big pi, but it is a pi. Okay. So when expected inflation goes up, that should lead to increases in nominal interest rates. But it's not going to, or it shouldn't lead to changes in real interest rates, assuming that everybody knows what's going on. Now, the problem is, as we talked about yesterday, though, what happens if the inflation is unexpected? Then it's going to change real interest rates, right? But if it's unexpected, real interest rates could change. And this is that whole deal we talked about yesterday with the ex ante real interest rate and ex post real interest rate. So I'm not going to go into all of this again, but we talked yesterday about how inflation can change real interest rates, right? So when inflation is unexpected, real interest rates can get distorted. But in general, if it's not expected, we would just expect the nominal inflation rate the nominal interest rate to adjust to keep the real interest rate steady. And is that what we see in the data? Yeah, but by the way, before I show you this, this is all called the Fisher effect. And the Fisher effect is just that a 1% increase in inflation should lead to a 1% increase in nominal interest rates. Right? That's what economists call the Fisher effect. A 1% increase in inflation should lead to a 1% increase in nominal interest rates. So I'm mainly interested in the graph here on the left. Hopefully you can see this. The green line is the interest rate. This is the interest rate on a 10-year treasury bond. And the purple line is the inflation rate. Do these things move together? Yeah. Over the long run, they move together. But do they move together perfectly? No. And why is that? Because sometimes these changes in inflation are unexpected, right? So remember what our equation says. A change in expected inflation should lead to a change in the nominal interest rate. But sometimes inflation is unexpected. Markets don't see it coming. And as a result, inflation changes, and then only later does the nominal interest rate catch up when people realize what's going on, okay? So you can see in general, yeah, there is a very close relationship between interest rates and inflation, right? That when inflation goes up, nominal interest rates go up. But the relationship is not perfect. And that's because oftentimes changes in inflation are unexpected. And so when they're unexpected, that leads to those distortions we talked about yesterday, right? That leads to those distortions in which it creates winners and losers and, fouls up financial markets. Okay, we got about half an hour here left. Let's just kind of change gears a bit and just talk about some, more, we've talked about some more kind of highbrow economic concepts, but let's kind of talk about some more pedestrian stuff. Just kind of a description of the US financial system. Right? So I think I told you yesterday, the end of chapter 10 has kind of a description of the US financial system. There is a lot of definitions here. I don't have time to talk about all of this in great detail. Once again, if you're somebody who really kind of follows, finance or taken some finance courses, you'll probably find chapter 10 straightforward and obvious. For those of you who haven't done as much as this, I would really encourage you to read this last half of chapter 10 carefully, because there's a lot of definitions in there that I think will help you, kind of understand some of the aspects of the US financial system. But when we talk about the US financial system, we're really talking about, there's really four big parts to the US financial system. There's bond markets. There's stock markets. There are financial intermediaries. These are institutions that facilitate finance. Included in this would be banks. But we'll talk about some other important financial intermediaries. And then there's foreign exchange markets, where you exchange currencies in other countries for dollars. The US financial system, listen, the US financial system is incredibly complex. We have a finance major here at Cornell where you can take 14 courses and you will not ever understand everything about the US financial system from those 14 courses, right? I mean, the US financial system is incredibly complex organization. But from a very, very macro level, and that's what we're doing in this class, right? An introductory macro level, you can really think about the financial system as having 4 parts. There's bond markets, stock markets, financial intermediaries, which includes banks, but there's a lot of other things in there, and then foreign exchange markets, okay? I want to talk about the first 3 here. We're not going to, at the last week of class, we'll kind of come back and talk about foreign exchange markets. So I'm not really going to say much about number 4, but I do want to say a few words about 1, 2, and 3, right? Just so that we're kind of all clear about what these things mean. So, bond markets. Any brave soul? Want to describe for me what a bond is?
It's a loan, and a government bond is like a loan to the government.
Yes, but it's not. What makes a bond as a type of loan? So what is it that makes a bond a bond? Anybody?
I mean, this is a half guess, but we learned about it a little in high school. Don't you like give money and there's a fixed amount of time? You can't touch that money and there's a fixed rate that you get back.
Right, that's a lot of it, right? That's a lot of it. Bonds, remember we said that finance is trading money across times with conditions attached. A bond basically has a lot of strict conditions attached to it, okay? So when you think about a bond, it has the name of the issuer or the borrower on it. It has a set maturity date, meaning the date that you repay. It has a face value. Meaning the amount that it repays at the maturity. And it has a stated nominal interest rate. Okay. So when the US government issues a bond, right, let's say that it issues a 10-year treasury bond. We'll talk about what a treasury, whenever you hear the word treasury associated with the bond, it's talking about a US government bond. What's a 10-year treasury bond mean? When it's issued, It's got the name of the US government. That's who, right? Borrowing the money. It's got a face value, meaning most treasury bonds are of an increment of $1,000 or $10,000. So let's say it's a $10,000 bond. What does that mean? At the maturity date, 10 years from now, you're going to get the $10,000 back. In the meantime, you get an interest rate. So if the interest rate is 2%, how much are you going to get every year?
$20.
You get, well, 2% of 10,000 is 200 bucks, right? So you get $200 each of the next 10 years, and then at the end of the 10 years, you'll get your last payment and you'll get the $10,000. Okay? That's how a bond works, a typical bond. Now, there are some weird bonds out there that don't necessarily have all 4 of these conditions, but for us, bonds typically have these 4 conditions, right? They typically have these 4 conditions. Here's the key. What price will a bond sell for? It can sell for a different price than the face value. Bonds can sell at different prices than face value, and this can impact your return on buying the bond. So let me give you an example to think about this. So let's think about that $10,000 treasury bond that has a 2% interest rate. That means at maturity, I'm going to get $10,000. What happens if I pay $900 for that bond? What's going to be true about my return on holding that bond? Am I just going to get 2%? No, I'm really getting more than 2%, right? Because I'm also getting that extra $100 at the end of the bond. Okay? So that's why the return on holding a bond is not the same thing as its stated interest rate. The stated interest rate tells you how much you get paid, but it doesn't tell you the true return. The true return is based on what price you paid. Okay? So for those of you who take finance classes, if you take money and banking with me, we'll talk about this in much more detail, right? And go through this. But I think this is one of the things that many people misunderstand about bonds. Many people, when they think about bonds, they think, well, that's safe, right? Because it's safe because it's got a stated interest rate on it and a stated maturity date on it. I can't lose money, right? Yeah, you can lose a lot of money, right? Because what happens if you ever have to sell that bond? You may not get the same price that you bought it for, right? You may not, right? And so that there are risks. There's big risks associated with holding a bond, right? Right? One risk is obviously bonds can change price. We call this interest rate risk. Okay. So once again, let's go back to this example of the $10,000 treasury bond that's selling at 2%. And so you buy it, and let's say you pay $10,000 for it, and so you pay exactly the face value for it. And then the day after you buy it, interest rates in the US skyrocket to 4%. What's just happened to the value of my bond? It's tanked, right? Because now somebody can go out and get the same bond that pays 4%. I got a bond that pays 2%, right? The market is not going to value that bond nearly as much. And if I have to sell it, am I going to be able to sell it for 10,000 bucks? No, I'm going to have to sell it for a lot more than $10,000. I could take a loss, and that's interest rate risk, right? So, you know, some people think, well, you can't lose money holding a bond. You definitely can lose money holding a bond, right? You definitely can lose money holding a bond. And it happens all the time, right? And so that's a risk, right? Bonds are not these risk-free kind of things. They definitely have risk associated with them. The other big risk, or there's two other risks, is default risk, right? What happens if the borrower doesn't pay you back? What happens if the borrower goes out of business? You may not get your money back, right? You may not get your money back. And so that's also a risk of holding a bond. Oftentimes, markets consider government bonds, here I should say federal government bonds, default risk-free. And what do I mean by that? The federal government technically can't default on their bonds. Why? For a very simple reason. They own printing presses. So if the government ever could not pay back their bills, they could just turn on the printing press, print up a bunch of dollar bills and pay back their bonds that way, right? There's nothing that prevents them from being able to do that. And so as a result, you know, I put quotations here because I don't, you know, listen, you never want to say never, right? I don't think anything is risk-free, right? Nothing is risk-free. But probably US federal government bonds are about as close to this as you can get, right? In the real world. And that's one of the reasons why they're so attractive to savers, not just in the US, but to internationally, right? These are probably about the safest things you can buy, right? In terms of financial assets. And then finally, many bonds have what are called liquidity risk. And what do I mean by liquidity risk? Can you sell it? Can you sell it? One of the reasons why government bonds are so attractive is because there's a huge market for them, right? About $10 billion a day are traded in US government bonds. So, you know, these big markets make it really easy for people to sell. But for other types of bonds, and somehow I skipped through this, let me circle back. But for other types of bonds, they're often not very easy to sell. I forgot to talk about kind of different types or categories of bonds. Sorry about that. So there's the US federal government bonds, right? And we usually call these either treasury bonds that have more than 1 year maturity, or treasury bills. A bill is just a bond that has less than 1 year of maturity. So these are very short-term bonds. There are corporate bonds. Corporate bonds are issued by corporations. Okay, like IBM, Apple, right? Municipal bonds. These are bonds that are issued by state and local governments. Okay? Municipal bonds are not the same thing as treasury bonds for one very important reason. Are these things risk-free? Can state and local governments default on their bonds? Absolutely, right? Go ask the people in Detroit, right? So it happens. It happens where state and local governments default on these bonds. So yeah, these things are not risk-free, right? Sometimes these things can have actually quite a bit of risk. A couple of years ago, bonds issued by Puerto Rico, right? Puerto Rico defaulted on some of their bonds, right? It's happened in Detroit. It happened in Orange County, California a few years back, right? So it can happen, right? It can happen. Municipal bonds, there's something else that's unusual about these. These things tend to be illiquid, meaning they tend to be very hard to sell. In part because, for instance, municipal bonds are often issued by local school systems, right? So a Mount Vernon school system has a bond issue. Who holds Mount Vernon school bonds? Probably the people around Mount Vernon or Iowa, right? Sometimes it's very hard to sell these things once you buy them, right? And so that's actually a risk of holding these. But there's one really nice thing about holding these. You don't have to pay a federal tax on the interest you receive. And so this is a huge tax shelter for the rich, quite honestly, is that rich people tend to hold lots of municipal bonds because it essentially is a tax shelter. Why does the government allow these bonds to be tax exempt? Well, it's basically, trying to help out state and local governments, right? Trying to help out state and local governments. I'm not 100% sure that makes a lot of sense economically, but that's the way it works. All right, and then we have finally securitized bonds. How many of you are familiar or heard of securitized bonds? Have you heard of mortgage-backed securities? You should have. If you've been paying attention, you should have. A mortgage-backed security is an example of a securitized bond. What does securitization mean? Turning a non-standard illiquid asset into a standardized liquid asset. Okay? The best way to understand this is by looking at an example. And the example is what's called a mortgage-backed security. Right? Sometimes these are called MBS, mortgage-backed securities. So there's a little history to this. Okay, so housing market. The housing market in the U.S. is a huge source of wealth, and it's a huge source of finance, right? Most people borrow money to buy a house, okay? So how did mortgages used to work in the U.S.? Back in the 1970s and before, if you wanted a mortgage, you went to your local bank, and you said, here's the house I want to buy. And the bank said, okay, well, you pay 20% of the house down, and I will fund you the other 80%. That gives me some safety. And then you just pay me for the next 20 or 30 years every month. And there's our deal. You shake our hands, that's how you do it. And so how did that work? It worked okay if you had money, right? But the thing of it is, it was very hard to get a loan, right? You had to have 20%. If you bought a house, you had to have at least 20% down. Interest rates were pretty high because what was that bank saying? They're going to lend you for 20 or 30 years, right? They are really locking into you for a long period of time. And banks really had very little opportunity to sell those mortgages. Like, could a bank turn around and sell a mortgage to another bank? Well, they could, but the problem with mortgages, you guys have never, most of you probably never bought a home, but mortgages are very strange things, right? They're tied to a specific piece of property. And so like if you got a mortgage here in Mount Vernon, it's tied to a piece of land in Mount Vernon, Iowa, where 99% of the world has no idea where that is. So how do I know what the land is? How do I know what the house is? Is it a nice place? Mortgages have strange prices, right? It's like $262,932, right? I mean, it's a strange price. They have different interest rates. They're non-standardized. And as a result, because they're not very standardized, they're not very attractive to sell. And they're very illiquid. So a bank, basically, when they issued you a mortgage, they were saying, I'm not holding the money for 20 or 30 years, okay? That's not the way the mortgages work nowadays. And why? Because the investment bankers on Wall Street had a brilliant idea. And their idea was, okay, a single mortgage is really unique and illiquid. But what happens if I buy 100,000 mortgages? Now that changes things, right? Because if I buy 100,000 mortgages, all those little idiosyncrasies get averaged away. Like now, if I can buy 100,000 mortgages across the country, I can kind of diversify myself. I don't have to worry so much about whether it's in Mount Vernon or Washington, Iowa, or on the West Coast or East Coast. If I can kind of diversify, get a bunch of different mortgages, and who cares if they're all strange prices, right? That's all going to even out if I get enough mortgages. Okay, so what I need to do is I need to buy a big pool of mortgages. How am I going to get that money? I'm going to issue a bond. I issue a bond that raises money, and then I use that money to buy mortgages. And then how do I pay the interest on the bond? Through the money that's being paid to me through the mortgages. And so that's what a mortgage-backed security is. It's a bond that is backed by mortgages. So, for instance, I just resold my house, or just refinanced my house a couple months ago. I did it through Hills Bank. Hills Bank held my mortgage for about 2 hours before they sold it to a mortgage securitization company, right? And so now my mortgage is a huge pool of other mortgages. Does it bug me? No, I just send the payment in, right? It doesn't make any difference to me. Actually, what's good for me is it's super easy. I get a super low interest rate, right? And that's, in general, this whole process has led to a huge increase in the standard of living of Americans because it's a lot easier to get a loan now because people really like to buy these mortgage-backed security bonds. And so the more people buy the bonds, the more money there is to lend out the housing market. It's led to lower interest rates. People can do things with very, very little down payments. Of course, this is also illustrative of the fact that you can have too much of a good thing, right? And that's what the global financial crisis of 2008 was about. That this became so attractive and banks were so excited to lend people money that who did they start lending money to? People that had no chance of paying it back. And so what this did is this fueled a big housing bubble where people started buying houses and borrowing like crazy, but they were buying houses they couldn't afford. And we'll kind of talk through this process a little bit later when we talk about the global financial crisis. But if at one point this boom became a bust, housing prices started to fall, people realized they had all these mortgages they couldn't pay, and they defaulted. What happened when they defaulted? All these bonds started defaulting. And who was holding these bonds? People like you or me, or banks, who started to get in trouble. And when banks start to get in trouble, the whole thing starts to crash, right? And that's that in a nutshell, without very much detail, is what happened in 2008, right? So, this is just a classic example of how something that's good can also be something that's bad when it gets to access, right? But this problem that we have with boom and bust. Okay, let's talk. Running quickly out of time. I'm going to warn you that we're probably going to go a few minutes over 11 o'clock, but I don't think we'll go much over. Because I want to talk about stock markets very quickly. And also want to talk about financial intermediaries. When we say a stock or an equity, what are we talking about here? What's different between a stock and a bond? Anybody? What's different between stock and a bond? What do you get when you buy a share of stock? Yeah, we like to think about it as ownership, right? You get a portion of the company. In reality, I don't think that's really the best way of thinking about it. You have to think about this as a share of limited ownership. And limited is very limited ownership, very limited ownership. Listen, if I buy a share of Apple, I just can't go into an Apple store and just take a phone and put it in my pocket and say, don't worry about it, right? I'm the boss around here. That's not how it works. Basically, the limited ownership means two things. You get to vote for the board of directors. And if the company distributes profits, you get a share of it. But that's really all you get. That's really all you get. Companies don't even have to distribute dividends, right? Companies can retain their profits. So, unlike a bond where there's a lot of, there's much more structure to what you get for a bond. In stocks, there's very little structure. You're not guaranteed much at all. You're not guaranteed much at all. However, there is one thing that probably most of us have never stopped to think about in regards to stocks that make them very, very appealing. And that is, really, we have stocks because we have corporations. And why do we have corporations? Because of the demand for limited liability. One of the important things about stocks is they give you the ability to own without the liability of being responsible for everything that the company does. So if I go out and buy a share of IBM, and then IBM goes bankrupt, and the people that IBM owes money to show up at my door and say, pay me. No, and that's different from if any of your parents run a small business, right? You run a small business, you are on the hook personally often, right? Unless you incorporate. And so by forming a corporation, you're really forming an independent person. And the nice thing about that independent person is then by owning a share of a corporation, you get limited liability. And this essentially reduces your risk, right? It reduces your downside risk. Are stocks riskier than bonds? You know what? I don't think there's a clear answer to that. They're risky in different ways, right? They're risky in different ways. Stocks have more default risk because basically if a company defaults, bondholders get paid off before stockholders do. Stockholders are the lowest rung, right? So if a company defaults, you're not probably going to get much at all, right? So, you know, there's less default risk for a bond. Bonds guarantee you more payments, but, you know, I mean, some stocks are, you know, particularly stocks of well-established companies can have very little risk, right? In terms of, you know, if you buy stocks of like a power company or something, Mid-American, I mean, they basically have the same dividend period after period after period, right? It's very predictable. So, you know, I think for our purposes, it's incorrect to say that stocks are riskier than bonds. They just have different types of risk. By the way, which is more important in the US financial system, stocks or bonds? What? More important. Trick question. What do we always hear about in the news? Stocks. Which one is more important? Bonds, right? Bonds has about twice as much lending, twice as much finance goes on in bonds as they do in stocks. So stocks, for whatever reason, are sexier. You know, they're a little bit more interesting, but as a practical perspective, bonds are a much bigger market. Bond markets are bigger than stock markets. Right? How do we follow stock markets? Well, I think I mentioned this yesterday. We follow them through stock indices. Things like the Dow Jones, S&P 500, the Franklin 5000, and these are very much like the Consumer Price Index. Except what's in your basket? Stock prices. How should people invest in stocks? Oh, wow, this is a $1 million question, right? This is a question that you could spend many blocks on, and for those of you who are finance majors, you will.
I should say invest in
Diversification, right? Diversification is the key. And in fact, what most economists tell you is that the best strategy is you buy a portfolio of stocks that looks just like the stock market, put your money in there and forget about it. Don't go trying to chase home runs or superstars, but just try to follow the market, right? Don't GameStop it. Why? Because did some people make money from GameStop? Yeah. Did some people lose money from GameStop? Hell yeah. And in the end, what's the safest play? Not to beat the market, but to try to follow along with the market, right? In the long run, doing what the market does is the best strategy, right? And so it's amazing, we can talk about this idea a lot more than we're going to do here, but it's amazing how many people don't really quite understand how much wealth can be created just following the market, right? So here's kind of a little interesting tidbit. We all like to think about Donald Trump, or at least Donald Trump, you know, conveyed himself as this great business person. This is not very big. It's kind of hard to see, sorry. Maybe that's a little bit better. But this is looking at, has Donald Trump outperformed the stock market, right? So he basically started off with some of his dad's money, what was it, about $10 million. And the question is, looking at Donald Trump's wealth today, would he have done better being an entrepreneur, or would he have done better putting his money in the stock market? And actually, if you look at how he performed, this is really hard to see, so I'll just kind of summarize it for you. But if you actually look, he has not beaten the stock market, right? He would be richer today if he just put his money in the stock market, right? And that's exactly the point. Very few people beat the market. And in fact, the evidence suggests that who is it that beats the market? What is it that beats the market? Luck. In other words, you cannot consistently beat the market. Yes, some people will, but it's not repeatable. It's essentially like flipping a coin. And so as a result, the best strategy for most investors is don't try to beat the market, just follow along with the market. All right, almost done here. Let me just say something about this third category of financial intermediaries. Financial intermediaries are essentially organizations that serve to match small savers with investors. Big or small. Right, so let's say I want to start a coffee shop here in Mount Vernon. Should I go to Wall Street and try to issue a bond? No. If I need $20,000 to start a coffee shop, there's guys on Wall Street that won't even bend over to pick up $20,000, right? It's small potatoes for them. Where do I get the money? A bank, because that's essentially what banks do. They specialize in small savers and small investors. Small business, small savers. And they try to do this all by reducing transaction costs, by getting good at what they do, right? By having automated systems where they can take care of credit, checking accounts, right? Having automated systems for people to have savings accounts and ATM machines and do online banking, right? So, with that, there's a lot to be said here about banks, but in many ways, what banks do is they fill in the cracks that bonds and stock markets miss, because bonds and stock markets are really for the big players. Banks fill in those cracks. Likewise, insurance companies. Are financial intermediaries. Because what do? Work with small savers and individuals, trading money now for money later, right? So if you think about a pension company, or life insurance, or health insurance, or any other kind of insurance, you pay them a premium. What do? They put that premium, invest it in an array of assets, knowing that at some point they're going to have payouts. So I don't know if any of you have thought about actuarial science major. Anybody thinking about that? So I mean, what is actuarial science? Actuarial science is really understanding the math and the statistics that goes into providing insurance, right? So it's actually very complicated, as you might imagine. But it's a highly remunerative field, right? You got to know a lot of math. It's hard to become one, but if you become one, you can make a lot of money, right? Because this is basically this gets down to probability, right? For any insurance company, you are in part invested. In part, you speculate in the stock market, and bond market, but in part, you're just probability, right? You're trying to figure out what's the chance that somebody dies, or what the chances that your clients die. The last thing we'll talk about here is a mutual fund. Anybody know what a mutual fund is or hold money in a mutual fund?
Is it where like, if me and you had a joint bank account?
No, it's not a joint bank account.
Like sharing?
Anybody? Yeah, Ruthie.
This is like a half guess, but is that where you give money to this company and they do the investing for you?
Right,
And like, there are a bunch of people who contribute their money for this investing.
right. So basically, what mutual funds do is they take small deposits. They take small deposits and then they invest in a portfolio of assets. These are hugely popular. The stock market, I think this is true of the bond market too, about half of all the financial assets in the US now are owned by mutual funds, which really means that they're owned by average Americans, right? Average Americans, you can put your money into this through like a retirement plan, or you can just put money into it. And so, you know, for colleges and universities, we have a big mutual fund plan called TIAA-CREF. I put money every month, send it to TIAA-CREF. What do? They've got a whole bunch of different funds. Some of them hold stocks, some of them hold bonds, some of them hold real estate, some of them hold combinations of all the three. But it really, the advantage of this for the average citizen is first diversification. There's no way that a small saver could be sufficiently diversified by themselves, right? Holding if let's say you got $10,000, how do you diversify that? You can't, right? A share of Apple now is what, $600 bucks, right? You're only going to be able to hold like 12, 14 shares. That's not diversification. What can I do? I can buy a share in a mutual fund, which will hold tiny bits of shares in thousands of different companies. That's diversification, right? That's what diversification is like. So you get diversification, you get the expertise of professionals, because it's professionals who run these plans, so you don't have to worry about it. Some of them keep costs low. Some of them don't. By the way, I mean, an economist will tell you that how should you look? What kind of mutual fund should you pick? The ones with the lowest costs, right? Those are usually the best mutual funds. So this is from your book, but just to give you an idea really quickly here, you know, what a mutual fund could look like. Here's the mutual fund from Fidelity Investments. And you just look at, this is just a stock market mutual fund, so it only has stocks. But about 3% of it is in Apple, 2.39 is in Microsoft, Amazon is 1.5, Wells Fargo Bank is 1.22. They hold hundreds, some of them thousands of different kinds of stocks, right? And so for most people, this is the way they should be investing, is putting their money in a mutual fund, because number one is diversified, right? So you can tell I've gotten up on my high horse a little bit about this whole GameStop thing, because I'm afraid that many people have learned exactly the wrong lesson from GameStop, which is that somehow there's some people out there that know better than everybody else. I don't think there's really much evidence of that, right? There are people who are sometimes lucky and sometimes unlucky, and that can be any of us, right, at any given point in time. So yeah, you know, betting on individual stocks, sometimes you can hit the lottery. On average, though, over the long run, there's not a lot of evidence that betting on individual stocks really does much. In fact, there's probably more evidence that it hurts you more than it helps you. And so for most people, putting money in a mutual fund is the way to go, right? Because it gives you the advantage of diversification, and then you don't have to worry about it. You put your money in there and you forget about it, right? What can be easier? So I'm an economist. You would think that I would be more than the regular person out there kind of following the financial markets and thinking, I don't spend one iota of energy on it, right? Because, you know, I realize that in the long run, paying attention to the ups and downs, that's not the best strategy, right? The best strategy is be in it for the long run. Don't try to ride the peak of the wave, but just try to ride the trend. And that's usually the strategy that's best for the vast majority of people. So, all right, I talked too much. I'm sorry, but you guys don't have to come back this afternoon. So I hope that's a little benefit. So that really takes us through the material for the first exam on Tuesday, okay? On Monday, we're going to talk about chapter 9, which really relates to that first question on your syllabus. Why are rich countries rich and poor countries poor? So we're going to begin to talk about that, okay? All right, have a good weekend. If you need to check in with me, I'll be checking my email.